Good evening, ladies and gentlemen. On behalf of Mulla Exchange Kuwait and Oman, Modern Exchange Oman, I welcome you to this evening's webinar on the impact of the revised tax rules on NRIs, especially pertaining to the implications of tax residency. Although I am also a chartered accountant, I have never been really very fond of Indian income tax, not just as a payer, but as a practitioner. So I leave it to the more diligent amongst our profession to share their views about this. Mulla Exchange and Modern Exchange Oman are pleased and privileged to host such events in the interest of our customers and our friends. And this is the first time we are trying this on. We've held events on Facebook Live, but this is the first time we are trying it on Microsoft Teams, since we wanted to even share some presentations on this. So let me just thank you for being valuable customers of Mulla Exchange and Modern Exchange Oman, and we look forward to your continued patronage. We are pleased to be the #1 exchange company in Kuwait by all parameters and the #3 in Oman. It is all because of your encouragement and support. Thank you. Now let me introduce Tuhin Chaturvedi, partner for taxation in RSM Kuwait, which is called Al-Bazi and Company here. Background is very simple. A month ago, there was a bit of a furor in the papers, in the Indian newspapers, about how do these new tax residency rules affect us in Kuwait, and there was this whole worry that our local incomes here would be taxed as global income, especially for those who earn more than 15 lakhs a year in India. So I reached out to him professionally, and he immediately agreed to do this webinar for us. So I'm very thankful to him. A bit of Tuhin's background: he is a Bachelor of Commerce from Delhi University, July '89, qualified as a CA, November '93. Has done in-depth tax course of the Canadian Institute of Chartered Accountants, July 2009. Was an engagement partner for 10 years with EY in Kuwait on tax compliance, tax advisory, and tax controversy. Has substantial experience of dealing at senior levels with the Kuwait Department of Inspection and Tax Claims. Has substantial international tax experience through a 4-year assignment in international tax with Deloitte in Calgary, Canada, where he was advising on inbound and outbound investments and detailed tax controversy discussions with the Canadian Revenue Agency. He spent 10 years with Schlumberger, and in that he actually was in multiple countries: Iran, Kuwait, Qatar, Yemen, Thailand, Myanmar, Vietnam, Bangladesh, Cambodia, and Laos. And he was responsible for tax compliance, planning, and controversy in MENA and Asia Pacific. So with this, I once again welcome you to this webinar. Due to constraints of the number of attendees, This seminar we have hosted on Microsoft Teams, and two constraints as viewers: you will be able to hear and see us, but you will not be able to participate in discussions, which is why we had asked you for your questionnaire. To those who wrote in to us, Tuhin has tried to capture as many of your questions, which he will try and answer. Another thing, let me share with you, is there would be a 15-second time lag when Tuhin changes his screen on his system, and you will be able to see the screen on your system. So in that 15 seconds, maybe Tuhin will be silent or may just talk about some other things. So you'll be able to see the old screen and not the new screen. So having said that, I look forward to a very interesting evening with you, and all the best. Please stay safe and well. Please get yourself vaccinated. Thank you. Josefa, if you can take over, please.
Okay, so Mr. Dawar, thank you so much for that wonderful introduction. Thank you for the opportunity. Thank you for your concern for all of us non-residents who are facing all these tax issues. And I think it was a great idea for you to organize this webinar. I hope it will be very useful for all the attendees who have registered. And I would also like to thank all the attendees who have taken time out from their busy schedules to spend an hour in Ramadan on Indian taxation. So, you know, I know we've got some glitches here and the technology issues which Mr. Dawar had referred to. So I won't, spend too much time. I'll just dive right into the topic. And while the slide shows on your screen, I'm going to, just give you a quick introduction on the structure for today. We'll spend a quick first few minutes giving you an introduction to RSM International and RSM Kuwait. We are then going to look at the economic clout of the NRIs. We'll spend some time looking in detail at the tax residence of individuals in India. We'll see how the impact of the tax residence on what the impact of the tax residence on taxation in India is. And we will then look at these two changes which have happened: the deemed resident change, which happened in 2020, and the liable to tax change, which has happened about a month ago, which is the one which Mr. Dawar was referring to. So RSM International is a world-leading provider of audit, tax, and consulting services to growth-focused organizations globally. We were founded in 1964, and we are headquartered in London in the United Kingdom. RSM International is the 6th largest global accountancy professional services network by revenue in 2020. And the 2020 revenues of RSM International were about $6.3 billion. RSM International has firms in over 120 countries around the world, combined staff of over 48,000. And we have more than 820 offices across MENA, the Americas, Europe, Africa, and Asia Pacific. And I've now moved on to the next slide relating to RSM Kuwait. So RSM Kuwait also has a very long history, almost the exact same amount of history as RSM International. RSM Kuwait was established in 1963, a few years after Kuwait's independence, as the Kuwait Auditing Office, Badr al-Bazia and Company. Mr. Badr al-Bazia was allotted auditor registration number 1A, and from 1990 to 2002, al-Bazia and Company was a full member firm of Arthur Andersen. It was actually Andersen Kuwait. And from 2003 onwards, al-Bazia and Company has been a full member of RSM. At the end of 2020, we had more than 200 employees in Kuwait, including 11 partners and senior directors, providing audit, tax, and consulting services. Our office is in Araya Tower in Kuwait City. Now, moving on to the global clout of the non-resident Indians. And I know there's a time lag, so I will adjust to that also. So I guess almost 90% or 95% of the audience on this call would be non-resident Indians, largely in Kuwait and also in Oman. Right? I'm a non-resident Indian myself. The global population of non-resident Indians is estimated at over 28 million. And I know that large numbers are very difficult to sort of get to grips with. So I always think of contextualizing them. So 28 million is about 7 times Kuwait's current population. So it's the global the population of non-resident Indians is approximately 7 times Kuwait's current population. So there are 7 Kuwaits. About 1/3 of this global population of NRIs is estimated to be in the GCC countries. And as we all know, the remittances. So India has one of the largest offshore remittances from its citizens flowing to India. In fact, that is a major contributor to India's economy. And a large number of us send money back through Mulla Exchange and other exchanges to support our families back home. So in terms of remittances, in 2002 and 3, the amount was just $16 billion, and that increased 5-fold by 2019 to about $83 billion. $83 billion, again, to contextualize, is about 70% of Kuwait's nominal GDP for 2018 of $118 billion. And NRI deposits with Indian banks were estimated in May 2020 to be about $131 billion, which again is about 110% of Kuwait's nominal 2018 GDP. Right. So that was a quick introduction to tell you about the non-resident Indians globally and their economic clout. We will now spend some time looking at tax residence. At the tax residence rules in the Income Tax Act of 1961. Right. So we look at this category. I think you can see the slide now. So essentially, the first category is that of a resident, and the tax residency of individuals in India is primarily determined on the days of physical presence in India during a financial year. The provisions relating to tax residency are contained in Section 6 of the Indian Income Tax Act. An individual is considered to be resident in India if he's in India for 182 days or more in a financial year, or in India for 60 days or more in a financial year, and 365 days or more during the 4 financial years before that financial year. So essentially, it's the second test is a test for a block of 5 financial years together. There are important exceptions to this test for residency. And these exceptions relate to condition 2B. These two exceptions are that where a citizen of India leaves India for employment during a financial year, the 60 days in 2B becomes 182 days. So essentially 2A and 2B become the same condition, 182 days. So the individual would be considered resident if he stayed in India for more than 182 days, and would be considered non-resident for that financial year in which he left to take up employment if he stayed in India for less than 182 days, right? And a financial year, as we all know, in India starts on April 1 and ends on March 31 of the next calendar year. And the second exception is, again, that if a citizen of India or a person of Indian origin outside India visits India, again, the 60 days in 2B becomes 182 days. So essentially, conditions A and B become the same, and the residency is determined on 182-day presence in that financial year. There has been a change. There has been a change, and from April 1, 2020, if a citizen of India or a person of Indian origin outside India visits India and his total income during the financial year, excluding foreign income, exceeds 15 lakhs, the number of days in 2B changes to 120 days. And Section 6 states that if a person is caught by this change, 2B changing to 120 days, then that person will be treated as a resident, but not ordinarily resident or an RNOR. Fine. I mean, this is a peculiar change, but the most important change which has occurred is number 4, where we have a new section 6(1)(a), which has introduced the category of a deemed resident from 1st April 2020. We will discuss this category of deemed resident in detail later. For the moment, all we need to note is that the Act specifies that if an individual is treated as a deemed resident, then that individual will be treated as an RNOR and not as a resident. And we will look at the implications of that shortly. I moved on to the next slide, but I'm just waiting for it to show up on your screens. And if an individual is not a resident or a deemed resident, he'll be a non-resident for tax purposes for that financial year. So there is no separate definition for a non-resident. It is essentially that if an individual is not considered to be a resident in India based on the number of days of physical presence, and is not considered to be a deemed resident, then that individual will fall in the non-resident category. We have this category of RNOR, which I've just spoken about, and this category applies to a resident and a deemed resident. So essentially, you could either be a resident for Indian income tax purposes, or you could be a non-resident. And if you are a resident for Indian income tax purposes or a deemed resident, then you could either be an RNOR or an ROR which means a resident and ordinarily resident. So if an individual is a resident or a deemed resident, he would be considered a resident but not ordinarily resident if either he is a non-resident in 9 out of the 10 financial years preceding the particular financial year, or during the 7 financial years preceding the particular financial year, he has been in India for not more than 729 days, or the case which we've discussed earlier, which is that an individual has been caught by the 60 days changing to 120 days, that individual would always be considered an RNOR. And then we have spoken about the deemed resident change which happened in 2020, where we have an explicit provision in the law which states that if an individual is deemed to be a resident, then that individual will only be considered a resident, an RNOR, i.e. a resident but not ordinarily resident, and will not be considered a full-fledged resident for tax purposes. Right. So I know this is a bit complicated, especially if you are encountering these definitions for the first time. And you know, there are lots of definitions to get your grips around. There are lots of you know, number of days to sort of keep in mind. And you would start wondering, you know, why a particular number of days has been selected and, you know, stuff like that. But basically, this is, if it's your first experience, then, you know, don't get too hung up on it. This is just the structure of the underlying legislation. Now, the good news is that, you know, we look at the structure of the underlying legislation, or we try to determine resident status of being a resident or a non-resident or an RNOR or an ROR, to look at what implication that resident status will have on the taxation of the individual's income in India during that financial year. Right? And thankfully, the implication is extremely simple. It is summarized in the table which you're seeing on the slides. We have 3 categories here. We have the first category of non-residents. We have the second category of RNORs, resident but not ordinarily resident. And we have the third category of resident RORs, resident and ordinarily resident. So as far as income received in India or income accruing or arising in India, it is taxable for all 3 categories of taxpayers: NRs, RNORs and RORs. Now, when we have income which accrues or arises outside India, then income accruing or arising outside India, for example, the salaries which we earn in Oman, in Kuwait, are not taxable for non-residents. You're seeing the yellow cross, and for RNORs, right? But of course, if one is considered to be an ROR, then that entire salary earned outside India, in say Kuwait, would be taxable in India. So you would ask yourself, okay, then what's the point of having 3 categories? Why can't we have 2 categories? So we have this category of RNOR, and the only difference between NR and RNOR is that where we have income which is accruing or arising outside India from a business controlled in India or a profession set up in India, that is taxable in the hands of an RNOR, but is not taxable in the hands of a non-resident. So here you see the yellow and the yellow cross and the green tick. That's the only difference between the taxation of income in the hands of an NR and an RNOR, and between NR and RNOR, income accruing or arising outside India from all other sources is not taxable in both their hands. I'm moving on to the next slide. And I'm again going to give you some time for this to show up on your screens. So now we come to the first very interesting change which occurred in 2020. And this is the change which relates to the deemed resident. So the Finance Act of 2020 inserted a section 61A applicable from 1st April 2020, which states that where an Indian citizen has total income other than foreign income of more than rupees 15 lakhs, i.e. income from sources within India of more than 15 lakhs during the financial year, he shall be deemed to be a resident in India in that financial year if he is not liable to tax in any other country or territory by reason of his domicile or residence, etc. Right. And the Finance Act further states, as we have already discussed, that where an individual is deemed to be a resident of India under 61A, that individual shall be treated as an RNOR. Thus, the only income, as we have just seen, the difference between a non-resident and an RNOR is that the only income for which the RNOR is additionally taxable in India is income accruing or arising outside India from a business controlled in or a profession set up in India. So the point is that even if a non-resident becomes a deemed resident and under this particular section, because he satisfies the conditions that he is an Indian citizen, he has income of more than 15 lakhs during a particular financial year, and he is not liable to tax in any other country by reason of domicile or residence, etc., then the only implication which this deeming provision would have is that this individual would become taxable in India for any income arising outside India relating to business controlled from India or a profession set up in India. Right? It does not have the implication that the RNORs or the deemed residents income in Kuwait or Oman would become taxable in India. Now, this particular change of, I've moved to the next slide. I'll again wait for the slide to show up on your screens. Okay, so you can see the slide now. Now, this particular deemed resident change was very relevant for Indian NRIs in GCC countries, since Indian NRIs in GCC countries are not liable to tax in the GCC countries, because none of the GCC countries at the moment has personal income taxation, and NRIs in GCC countries are usually citizens of India. They have not forsaken their Indian citizenship and become persons of Indian origin by taking on the citizenship of other countries, right? Now, it was initially reported by the media in 2020 that NRIs will be treated as residents and not RNORs, implying full taxation in India of all income outside India, including salary income and business income outside India, from a business controlled outside India or profession set up outside India. And that set off a huge amount of panic in 2020 amongst the Indian diaspora in the GCC. I also remember that, I was reading these articles in about February 2020, and I was also quite surprised, puzzled, worried. A few of my friends are calling me from India, and they seem to be very happy that finally I who had escaped the Indian tax man and tax net for so many years, was finally going to be caught by the Indian tax man, um, and we were sort of moving to a system of global taxation. Now, the panic became so much and that the CBDT, the Central Board of Direct Taxes, had to clarify in a press release, which they issued very promptly on 2nd February 2020, that the deemed resident provision is an anti-abuse provision. It is aimed at tax nomads and perpetual travelers. It does not target non-resident Indians in the GCC countries. It does not target those non-resident Indians in the GCC countries who are actually employed here or who are conducting their business here, who are bona fide workers in the Middle East. And the income of these bona fide workers will not be taxable in India. The income earned by these bona fide workers outside India will not be taxable in India. They will be treated as RNOR. So as we will remember from all this discussion we've been having on RNORs, the only difference would be that if they earn any income outside India from a business controlled in India or a profession set up in India, then by reason of them being considered as RNORs, only that particular portion would be considered to be taxable in India. And there was no question of their global income or their income accruing or arising to them in the Middle East being taxable in India. However, as is usually the case, the moment this news came, it spread like wildfire. And people started, as I told you, my friends started calling me and being extremely happy. And I started seeing all these news articles and stuff. And many of you would, I think, have had the same experiences and been sort of disconcerted, frightened, panicked, worried, obviously worried. Right now, I see you can see this. So I looked at some of the news articles from that time. This is just an illustration. I have nothing against the Mint or any other publication. This is the one I could readily find on Google, using Google. Right, so this is an article from 1st February 2020, and you will see that the headline says, NRIs not taxed in any country will pay tax in India. Right? And of course, NRIs in the GCC countries know that they are not taxed in any country. Right? And then similarly, I have moved on to the next slide, which is a slide from the Business Standard, which again says the same thing. It says Budget 2020, NRIs not paying tax in other countries will be taxed in India. Right. So I'll just wait for that to show up on your screens, right? And or what I will do is I'll try to skip to the next slide, right? Which I think is, so the next slide is actually the slide of the press release from the Central Board of Direct Taxes. And I will wait for that to show up on your screen because I'm going to read from that press release. While it shows up, I mean, one of the criticisms which we've had all along is that all this clarification has been done through a press release. There has been no clarification in the Act itself. And as we know, I mean, press releases are not law, right? But again, as we've seen, at least as far as the deemed resident provision is concerned, there is a very explicit explanation in the law in the Income Tax Act that if an individual is deemed to be a resident, then that individual will only be treated as an RNOR. So reading from this press release, it says that the new provision is not intended to include in TaxNet those Indian citizens who are bona fide workers in other countries. In some sections of the media, the new provision is being interpreted to create an impression that those Indians who are bona fide workers in other countries, including in the Middle East, and who are not liable to tax in these countries will be taxed in India on the income that they have earned in the Middle East. This interpretation is not correct. It is clarified that in case of an Indian citizen who becomes a deemed resident of India under this proposed provision, income earned outside India by him shall not be taxed in India unless it is derived from an Indian business or profession. So this is the reference to the RNOR difference which we have seen. And they're trying to say that unless it is derived from an Indian business controlled in India or an Indian profession set up in India. And it went on to say that the necessary clarification, if required, shall be incorporated in the relevant provision of the law. So this came as very welcome relief. And I called my friends back and I said, so did you see the press release, or should I'll WhatsApp it to you and I'll email it to you. And they said, yeah, I mean, you've escaped this time. But let's hope the Indian taxman catches up with you soon and your global income starts getting taxed in India. Okay, thank you very much. You're good friends. Nice to have you. And then the other change which has happened is it is a change which has happened in maybe 2-3 months ago, right? And in the budget which was presented in 2021, there was a provision which said that India would start defining the term liable to tax. The term liable to tax would now be defined in the legislation. Now, we have just seen that, the deemed resident provision has a reference to an individual who is not liable to tax. But the liable to tax, which we are referring to here, is not relevant so much for India's domestic legislation, but it is relevant for tax treaties. Right? And I'll just explain to you how it is relevant to tax treaties. So, I mean, as you know, when we are talking about taxation in India, we have the domestic law of India, the Income Tax Act. And then if we are non-residents or residents in a particular non-NRIs, etc. in Kuwait, we also have a tax treaty between, say, Kuwait and India. And the tax treaty sits above the domestic law. So the tax treaty works to protect us, right? But one of the conditions in order to take the advantage of the tax treaty or to take the benefit of the tax treaty is essentially that we should be a resident in that particular country. We should be considered a resident of that particular country as per the tax treaty. And many tax treaties defined residents as those who are liable to tax in that particular country. And that is why this attempt to define liable to tax is relevant more for tax treaties than for domestic law. So, to give you a background, I'll give you the background and I will also move to the next slide. Right. So essentially the term liable to tax was not defined in Indian legislation. And the Indian courts had usually taken a very broad view of the matter and had said that if a person is a resident in a particular country and the government of that physically present in a particular country, and the country has the right to impose a tax on that person, then it does not matter whether a tax is actually imposed or not imposed, or a tax is paid by that person or not paid. That person shall be considered liable to tax in that particular country for the purposes of India's double taxation agreements. And the Supreme Court had made a pronouncement which is considered to be an authoritative pronouncement, which has been followed largely or almost always subsequently. That was a pronouncement which is referred to as the Supreme Court's judgment in the Azadi Bachao Andolan case in 2003, where the Supreme Court took this very broad view of, it does not matter whether tax is actually imposed or not imposed, as long as the government of that particular country has the right to impose tax on that resident, and it may impose tax in the future, that person shall be considered to be liable for tax for the purposes of the tax treaty between India and that particular country. So now what we see here is that the Indian government is proposing a definition of liable to tax, is proposing to sort of define this term in the legislation. And it says in relation to a person liable to tax means that there is a liability of tax on such person under any law for the time being in force in any country, right, and shall include, etc., etc. So we are not going into that, but basically what it is saying is that you will be considered to be liable for tax for the purposes of claiming treaty benefits if there is an actual law in the country in which you are resident which subjects you to tax. So there is, there is a present liability to tax. There is a law in force in that country and there is a present liability to tax. So the very broad and very generous interpretation of Azadi Bachao Andolan has been done away with. And we have now come to a very strict interpretation which says that unless there is a law in force in the country which imposes a liability of tax on the person will not be considered to be liable to tax. Okay. Now we've seen this movement in other cases also. I recently wrote an article of a change which has also happened in this year's budget, where a long-standing position of the Supreme Court relating to the ability to claim depreciation on goodwill has also been reversed by the government. So anyway, moving on to this liable to tax, etc., the effects of this definition being incorporated in the domestic law Basically, as I've said, this definition this definition may affect the ability of a person to claim treaty benefits, but the effect will depend upon the particular treaty which we are looking at. Now, for example, in Kuwait, an Indian individual is considered to be resident of Kuwait if he is present in Kuwait for more than 183 days in the financial year. Thus, an NRI in Kuwait does not need to be liable to tax in Kuwait in order to claim treaty benefits. Therefore, even if the definition of liable to tax changes in Indian legislation, it does not affect the ability of an individual in Kuwait, of a natural person, a human being in Kuwait, to claim the benefits of the treaty between India and Kuwait. However, it then does start affecting the ability of a Kuwaiti company to claim the benefit of the treaty between India and Kuwait. I moved on to the next slide. It'll show up on your screens momentarily. So what happens is that when we come to companies, the treaty refers to liable to tax. And, as all of us who work in taxation in Kuwait know, that in Kuwait, Kuwaiti companies are subject to zakat and NLST, except for WLLs or with limited liability companies, which are not subject to tax in Kuwait. And therefore, there is a potential risk that these WLLs who were claiming benefits under the Kuwait-India Treaty, as far as income from sourced in India was concerned, may now no longer be eligible to claim the benefits of the Kuwait-India Treaty. However, as I've written here, this is an evolving issue. It's just happened 3 months ago. And there are many questions or implications which remain unanswered, regarding this definition. Now, this definition does not tell us what is a tax. Right? It says, so it doesn't define taxes. So are we talking only of the taxes which are covered in the treaty and specifically mentioned in the treaty? Or are we talking of all particular type of taxes? Right? That's not clear. Okay, what about VAT? And, would liability to VAT be considered to be liability to tax? So in the United Arab Emirates, for example, where companies are not liable to any corporate tax, they are liable to VAT. So what would happen in that case? What about entities and individuals which have tax residency certificates, which have been issued by the tax authorities of the GCC countries, right? And they are in possession of those certificates and they can always obtain those certificates in future. And we have the larger question that can India unilaterally define the meaning of liable to tax for the purpose of providing treaty benefits, and will this be accepted by treaty partners? Right. So these are some of the questions. Of course, I've got this clipping from the 2nd of February. We now have again the same sort of panic. This is from the Economic Times of the 2nd of February. We have this liable to tax redefined jolt for a whole host of Indian businessmen with offshore connections, and blah blah blah. So, but we have seen this movie before, right? So we know that there will be this panic. There will be, in an attempt to get what is called clickbait. This is essentially clickbait. You put a headline which is so outlandish or unexamined that you essentially sort of ensure that the person will click on the link and will read it, and when he or she actually reads it, they will find that the facts are very different. But it whips up a panic, it whips up a frenzy, And, and that is something which is counterproductive. And at this moment, when we are all encountering COVID, and we are all personally suffering, and our country is suffering from COVID, from our country and our adopted homelands, are all suffering from COVID. This is not the time to sort of stir up this panic. So yeah, with that, it brings me to the end of my presentation, right? And we've got 5 minutes left to 6 o'clock, so that's excellent timing. On your screens, you will find my email address, right? And you are welcome to email me with particular questions if you have them. I did receive, questions, as Mr. Davar had said, and I've made my best attempt to sort of answer those questions in this presentation. I'm very glad that I've been able to attend to finish by 5:55. We have a curfew in Kuwait, which starts in 1 hour, so I need to get home quickly. And I'm now going to hand it over to Mr. Davar for concluding remarks. Thank you so much. Josefa, could you please now hand it over to Mr. Davar?
So good evening, ladies and gentlemen. Thank you for attending this event despite your hectic schedules. We would like to thank Mr. Tuhin for this very illuminating talk. I'm sure many of your questions must have been answered, and there will be more questions which must be coming out after this presentation. So as Mr. Tuhin said, you can reach out directly to him, tuhin.chaturvedi@rsm.com.kw. In case you are not able to reach out to him, please feel free to reach out to Mulla Exchange. We are here for you. And thank you, everyone, and have a lovely evening. Thank you.